2025 was supposed to be India's victory lap, but while GDP headlines celebrate, the Indian rupee has quietly started bleeding in the background. It hasn't just slipped a little, it crashed through 90 rupees per dollar, becoming Asia's worst performing currency, and that detail changes everything about the story. Now, it feels logical on the surface to ignore this because growth numbers look strong and official statements keep sounding calm and confident. But let me tell you something important. A falling currency is not background noise. It's the market whispering doubts we should probably listen to. In my experience, when leaders say all is well while markets panic, that gap itself becomes the real signal worth paying attention to. Here is where the contradiction starts getting uncomfortable because we are told India is booming, yet global investors are dumping the rupee aggressively. Now, it's completely natural to think markets can be wrong, emotionally or even biased against emerging economics like ours. But markets have one brutal habit. They vote with real money, and right now, that vote is clearly moving away from the rupee. What I like to think of this as a trust meter. Unfortunately, trust in India's currency has been steadily leaking this year. To understand why, we need to simplify currencies because exchange rates sound complex but behave like everyday buying and selling. Think of the rupee as a product on a shelf whose price go up when people want it or collapse when buyers disappear. People buy rupees when they want Indian stocks, factories or services, and they sell rupees when the better or safer options appear elsewhere. Now stay with me here because 2025 created a perfect storm where almost every force pushed investors towards the exit simultaneously. First is a strong US dollar, which feels boring but powerful because global fear always pushes money towards America like gravity. When wars, elections, and trade tensions rise, investors don't chase returns. They chase safety and the dollar becomes their bunker. Second comes a big shock most people underestimate. The massive foreign investor exit that quietly drained dollars from our markets. Let's be specific. FIIs pulled roughly $16.5 billion out of India in 2025. And that money didn't hesitate. They sold Indian shares, converted rupees into dollars and left, creating a sudden dollar shortage, and that smashed the exchange rate. Now it feels logical to blame speculators here because selling pressure always looks malicious from the outside. But here is an uncomfortable correction. Investors don't owe loyalty. They follow risk-adjusted returns, and India stopped winning that comparison. The third pressure point is trade, where India keeps spending far more dollars than it earns. In October alone, the trade deficit touched $41.7 billion, which is like running a business that leaks cash constantly. What I personally understand, this is a bucket with a hole, where every import widens the gap faster than exports can fill it. And remember, imports are not luxury items alone. They include oil, fertilizers, electronics, and essential we cannot easily replace. The fourth factor quietly amplifying everything is dollar-denominated debt, which sounds harmless until currency math turns vicious. Let's say India borrows at 2% interest rate, but rupee falls 5%, suddenly repayment feels like 7% pressure. Now, it's natural to think governments can manage this easily because debt numbers don't visibly change overnight. But currency weakness silently increases the real burden, forcing more growth just to stand still. At this point, some experts confidently say a weak rupee is actually good because exports become cheaper and more competitive globally. Now this feels logical on the surface because lower prices usually help sellers win more customers. Here is where the idea breaks down for India because we are not China. Our economy isn't built primarily on exports. India imports about 85% of crude oil along with fertilizers, chips, and edible oils powering everyday production. So when the rupee falls, the cost of raw material rises first, quietly eating any export advantage before profits appear. What I like to think of this as is running faster on a treadmill that keeps speeding up underneath your feet. Even shipping exported goods become more expensive because fuel prices rise. Following the currency benefits entirely. Now let's bring this home because currency charts feel abstract until they hit real lives and real paychecks. The first impact is psychological because falling currency quietly dents national confidence even if we don't consciously admit it. But the deeper impact is economic because your labor gets devalued globally without you changing anything about your effort. Imagine an Indian and Australian freelancer doing identical work. As the rupee falls, 1 hour of Indian labor buys less worldwide. You're working just as hard, but your slice of global pie keeps shrinking visibly. Meanwhile, the wealthy hedge currency risk, diversify abroad, or move capital, cushioning themselves from most of this pain. The middle class and poor don't get those tools. They pay through imported inflation hidden inside daily necessities. Your LPG cylinder, medicines, smartphones, and even education costs quietly rise because the rupee weakens against the dollar. Now, there is one important nuance here because not every currency fall is automatically a crisis. Short term depreciation during global shocks can be managed if fundamentals are strong and confidence returns quickly. But what worries me personally is normalization. When leaders downplay persistent weakness as harmless or even beneficial, a stable currency usually reflects policy clarity, a fiscal discipline, and believable long term direction. So, what's the way out realistically? Without slogans or overnight miracles. First, India needs deeper manufacturing that actually replaces imports, not assembly lines dependent on foreign components. Second, relying on hot foreign money to prop the markets is risky because it leaves the rupee vulnerable to sudden exits. There's also a talk of de-dollarization, trading in local currencies, which sounds bold and strategic. But let's be honest, the path is slow, complex, and politically sensitive, especially in a fragmented global economy. In my experience, currencies stabilize when policy signals align consistently, not when narratives trying overpowering numbers. That brings us to accountability, which often feels uncomfortable but matters more than technical explanations. You can't celebrate GDP growth while treating currency collapse as a minor adjustment caused by external villains. The government is the custodian of rupee just as much as it claims ownership of growth statistics. If India truly wants superpower status, currency stability cannot be treated as optional or cosmetic. The rupee is not just a paper or digits on a screen. It's a trust, productivity, and future purchasing power combined. When that trust erodes, everyone pays even if the pain arrives slowly and unevenly. So the real question is not whether the rupee fell, but why the response feels so casual. What I would love to know from you is whether this feels like a temporary turbulence or a deeper structural warning. Because once confidence slips too far, restoring it becomes much harder than protecting it early. If this breakdown helped you see the currency story differently, that's the conversation I wanted to start. And if you want, I can next explain how the RBI actually intervened during crashes step by step without jargon. For now, remember this: strong nations don't just grow fast, they protect the value of their people's work.